Right now, about 20% of the world's daily energy supply is just entirely trapped behind this newly minted, basically hostile toll booth.
Yeah, it's a massive bottleneck.
Right. We are looking at a 96% blockage in the globe's most vital economic artery. And the symptoms of that, they're already showing up in your mortgage rates, your local grocery aisle, and, your retirement portfolio.
Absolutely everywhere.
So welcome to this deep dive. Today is March 26, 2026, and our mission today is to kind of cut through the overwhelming noise of the global news cycle for you.
And there is a lot of noise out there right now.
There really is. So we've taken this huge stack of sources. We've got research from the Kleinman Center for Energy Policy, raw trading data, some intense geopolitical analyses, and these incredibly dense tech legal briefings. And we are just going to connect the dots.
Because you simply cannot look at any of these events in isolation anymore.
No, definitely not.
I mean, to understand what is happening in the stock market today, or even why you are paying what you're paying at your local gas pump, you have to look at how these global dominoes fall. And all of today's dominoes, they start falling from this single, highly contested body of water in the Middle East.
Okay, let's unpack this. Because the material today, it paints a picture of a world undergoing, a profound structural realignment. We are entering an era of what analysts in our sources are calling geo-stagflation.
Right, geo-stagflation.
Which is just that dreaded scenario where a geopolitical conflict simultaneously chokes off economic growth while, driving up prices on basically everything.
It is the absolute worst-case scenario. For central bankers and everyday consumers alike, I mean, the epicenter of this geo-stagflation is the war between the U.S., Israel, and Iran.
Which we're, a month into now?
Almost, yeah. It's approaching its 1-month mark. It started back on February 28th. And the mechanism that is actually causing this global economic heart attack is the effective closure of the Strait of Hormuz.
Right, and I want to focus on the mechanics of that waterway for a second, because the numbers here are just staggering. I kind of view it like the world's most vital cardiovascular artery.
That's a great way to put it.
Yeah, because in normal times, 20% of all global oil consumption passes through this one very narrow geographical choke point. And if you isolate just the oil transported by ships, it's over 30%. We are talking about an average of like 120 massive vessel transits every single day.
Right.
But right now, that transit number has plummeted down to just 4.
It's wild.
4 ships a day. That is where we get that 96% blockage. It's basically cardiac arrest for the global economy.
And the reason for that blockage is this radical shift in military strategy.
Yeah.
Because Iran has reportedly laid mines in the strait.
Oh, wow. Which obviously just destroys the insurance market for these ships.
Exactly. It immediately causes maritime insurance premiums to skyrocket, which effectively freezes commercial shipping.
Right.
But, and this is key, they aren't just trying to block it. They are attempting to turn an international free-flowing waterway into a sovereign maritime toll booth. Our briefings show they are actively drafting legislation to charge fees for the safe transit of non-hostile ships.
Charging a toll on a fifth of the world's energy supply. I mean, that fundamentally alters the global cost of doing business.
Oh, completely.
Now, obviously, there are these intense diplomatic maneuvers happening to try and clear this up. The sources indicate that the Trump administration sent a 15-point peace proposal to Iran.
Right. They used Pakistani intermediaries for that.
Yeah, via Pakistan. But Iran rejected it, issuing their own counterdemands. Meanwhile, Trump extended a pause on striking Iranian energy plants to April 6th. And, to be totally clear here, we are just objectively reporting these actions to explain the market reactions.
Exactly.
We aren't endorsing any political viewpoint or administration. The market doesn't care about the politics of the Trump administration's pause or the intermediaries. Traders are reacting purely to the math of the delay. We're just reading the tape.
And the tape is showing immense volatility right now. I mean, when that pause was announced, traders actually started throwing around this acronym, TACO.
TACO.
Yeah, it stands for Trump always chickens out.
Oh, wow. Okay.
Yeah, and as that sentiment spread, oil prices actually pared back some of their massive gains. But, and we have to be careful here, we really have to put pared back into context.
Right, because it's still incredibly high.
Exactly. WTI crude, which is the U.S. domestic benchmark, is still sitting around $94.50 a barrel. And Brent crude, the international benchmark for the global price of oil, that has breached the $100 mark.
Which is insane.
It is. The fact that Brent is trading at such a high premium, it just shows how much global panic is baked into the loss of the strait?
Just to give you a sense of the sheer violence of this market move, our sources noted that at certain points, the speed of this price spike outpaced the initial 2022 Russia-Ukraine shock by 17 times.
17 times faster is unbelievable.
It's like the global economy didn't even have a second to brace for impact. Which, well, that brings us to the domestic reality. We mentioned geo-stagflation earlier. Let's look at the actual macroeconomic numbers because they explain exactly why things feel so difficult right now for everyone.
Yeah, the transition from global geopolitics to Main Street is brutal right now.
It really is. The U.S. economy's fourth quarter 2025 GDP growth was just revised sharply downward to a completely stagnant 0.7%.
So growth is essentially flatlining.
Right.
But at the exact same time, core PCE inflation has reaccelerated to 3.1%.
And core PCE, just as a reminder, that stands for personal consumption expenditures. It's the specific metric the Federal Reserve watches closest, right?
Exactly, because it strips out the bouncy, unpredictable costs of food and energy to show us the true underlying trend of inflation. So the fact that core PCE is rising means the inflation from the Middle East energy shock has already seeped deep into the broader everyday economy.
So let me get this straight. The economy is stalling out, but the cost of living is accelerating. Usually if growth crashes, the Fed cuts interest rates to stimulate the economy, right?
Yeah.
To make borrowing cheaper.
Usually, yes.
But if inflation is rising, they have to raise rates to cool demand down.
Oh, well.
So they are completely trapped.
They are completely trapped. And this trap has forced the Federal Reserve into what economists are now calling a hawkish pause. They're holding rates steady at 3.50 to 3.75%.
Okay.
But what's truly critical here is how they are viewing the long-term landscape. The Fed has revised its estimate of the neutral rate up to 3.0%.
Okay, let's explain that because neutral rate sounds like dry financial jargon, but it's actually the invisible force of gravity for the entire economy.
It really is. The neutral rate, often written as R-star in economic models, is the theoretical interest rate that neither stimulates economic growth nor restricts it. You can think of it as the baseline cost of money.
Now, for the last decade, the market assumed this rate was anchored around 2.5%. By revising it up to 3.0%, policymakers are signaling a collective belief that the baseline cost of capital is just permanently higher now. The era of cheap money is officially over.
Wow. So the floor has basically been raised.
Yes.
And the bond market is screaming this reality right now. I mean, the 30-year Treasury yield is nearing 5%, which sits in its 95th percentile historically.
Which is incredibly high.
Yeah. When long-term Treasury yields are that high, it means the cost of borrowing for everything from, a family applying for a 30-year mortgage to a corporation taking out an expansion loan.
Yeah.
It is painfully expensive.
And the real-world impacts of this geo-stagflation, they are highly localized but universally felt.
Well, for sure.
Take Kansas, for example. You wouldn't think a closed strait in the Middle East would immediately impact the American Midwest, but up to 30% of global nitrogen fertilizer exports pass through the Strait of Hormuz.
And that fertilizer is an essential, totally irreplaceable input for Kansas corn production. That's an industry that supports 16,000 jobs statewide. The supply chain is just so fragile that a disruption a world away literally threatens their upcoming planting season.
And then you look at California, where the average gas price is nearing $5.85 a gallon.
Ouch.
Yeah. In Los Angeles County alone, 45% of residents rely solely on cars for transportation. That is a massive, unavoidable tax on daily life. And the data shows overdue car loans are already rising out there because wages just aren't keeping up with the pump.
It's squeezing everyone.
And it's not just regular commuters. In Texas, the trucking industry provides 780,000 jobs. Diesel fuel has surged by $1.60 a gallon in just the last month.
Wow, $1.60.
Right. The margins for those independent truckers are vanishing overnight. And President Trump actually remarked on these rising gas prices. He said, quote, "If they rise, unquote." He's framing the economic pain as a temporary, unavoidable necessity for national security.
Right. Again, just objectively looking at the policy angle here, he is attempting to balance the geopolitical necessity of containing Iran against the acute domestic economic reality.
Yeah, but here's where it gets really interesting, though. I'm looking at these sources, and I have to push back a bit on the traditional economic logic here.
Okay, lay out on me.
If growth is crashing down to 0.7%, and costs for fuel and borrowing are absolutely soaring, traditional logic dictates companies should be laying people off in droves to protect their margins, right?
That is the historical playbook,
Yeah, I
yes.
mean, during the 2008 financial crisis or the 2020 pandemic, job losses were immediate and massive. Yet, our
Yeah.
data today shows the labor market is in this weird low fire state.
Yeah.
Jobless claims are remaining incredibly stable right around 210,000. Why the disconnect?
What's fascinating here is that it highlights a deep psychological shift in the corporate market. Corporate executives are suffering from a kind of institutional trauma from the post-pandemic era.
Trauma.
Yeah, they vividly remember the severe, agonizing labor shortages of 2022 and 2023. I mean, they spent absolute fortunes trying to recruit, train, and retain staff during the Great Resignation.
Ah, okay. So the cost of replacing a worker later is deemed higher than the cost of keeping an idle worker right now.
Precisely. Even as their profit margins are being aggressively squeezed by 5% interest rates and $100 oil, they are terrified to let workers go. They believe that if they fire people now to save a few dollars, they will never be able to hire them back when the economy eventually recovers.
Wow.
So we are left with this bizarre labor stalemate. No one is hiring because the macroeconomic outlook is terrifying, but no one is firing because institutional memory tells them labor is their most scarce, difficult to replace resource.
That is wild. So if Main Street executives are too terrified to fire anyone and they're just hoarding their cash to survive this stagflationary stalemate, where is all the real investment capital running to hide?
It's moving fast.
Yeah. Wall Street is violently rotating right now. Capital is fleeing straight to the sectors that offer immediate, tangible utility. And right now, unfortunately, the most tangible reality is a global weapons shortage.
Yeah, because when you can get a nearly 5% yield on a virtually risk-free government bond, investors demand that their stock portfolios offer incredible growth to justify the risk. And the defense sector is providing exactly that right now.
Because the burn rate.
Exactly. The U.S. military and its allies burned through 11,000 munitions in just 16 days of conflict. That is $26 billion worth of weapons essentially evaporated, requiring immediate replacement.
And this burn rate is driving a massive boom in rare earth mining stocks, right? ETFs like RMMX and specific companies like MP Materials.
Yeah.
Because a modern Tomahawk missile isn't just an explosive tube.
No, not at all.
It's basically a flying supercomputer that has to survive immense atmospheric friction.
Right. The guidance systems, the actuators, and the tail fins of those missiles rely on very specific rare earth elements, things like samarium cobalt magnets.
Samarium cobalt.
Okay,
Oh.
yeah. And it's highly prized because it can maintain its magnetic properties under the extreme blistering heat generated by a missile in supersonic flight. You literally cannot guide these weapons without it.
Wow.
So as the U.S. scrambles to replenish its depleted stockpiles, the companies that mine and process those specific heat-resistant elements become immensely valuable overnight. They are drawing massive inflows of capital.
Which makes total sense. But while defense hardware is booming based on physical realities, the tech sector, which has been the darling of Wall Street for years, is experiencing a violent bifurcation based on software realities.
This is such a fascinating pivot.
It entirely inverts the thesis we've held for the last 2 years about AI hardware. We've all heard about the AI boom, and the assumption was that artificial intelligence would require an infinite, exponentially growing supply of memory chips to process data.
Right, the infinite demand narrative.
Exactly. But this week, AI memory stocks giants like Micron and SanDisk, they plunged. And they plunged because of a software announcement from Google.
Yeah, Google unveiled a new AI model called TurboQuant. And to understand why this crashed memory stocks, you have to look at how large language models actually work.
Okay.
The innovation with TurboQuant is that it highly optimizes what is called the key value cache. Essentially, it stores the context and past calculations of an AI model in a highly compressed format. So instead of the system having to constantly reload and recalculate the entire conversation history into active RAM every single time it generates a new word, it just pulls from this optimized cache.
Ah, so it remembers the math it already did, which means it requires significantly less active memory to function.
Exactly.
It's like the AI gold rush just realized they don't need as many pickaxes anymore, thanks to Google.
Yeah.
But at the same time, they're desperately willing to pay top dollar for the ice to cool down the miners who are still working in these data centers.
That is a perfect analogy. While the memory chip sector sold off because of software efficiency, the physical infrastructure required to keep the remaining AI data centers from literally melting down is generating unprecedented wealth.
It's crazy.
I mean, the private equity firm, KKR, just sold a data center cooling business. And the deal was so lucrative that it resulted in massive $240,000 payouts for every single employee of that company.
Wow.
The physical reality of dissipating heat is the new bottleneck for the internet.
$250,000 per employee just for keeping the servers cold. That is incredible. But the adaptation doesn't stop with tech hardware. The flow of capital is forcing the entire financial sector to radically restructure, too, just to survive the Fed's higher for longer interest rates.
Yes, rippling everywhere.
We are seeing massive corporate megadeals born out of pure necessity, like the merger between Equitable Holdings and Corebridge Financial.
Right. They just announced a $22 billion all-stock merger. Combined, they will manage $1.5 trillion in assets.
That's a staggering amount of money. But,
Yeah.
Why do a $22 billion merger in the middle of a geopolitical crisis and a 5% bond market?
Yeah. If we connect this to the bigger picture, merging is really the only way to manufacture growth when borrowing is too expensive. In a zero interest rate world, companies just borrow cheap money to expand.
Sure.
But in a 5% world, your margins are razor thin. When you can't rely on cheap debt, your only avenue for growth is ruthlessly cutting internal overhead.
Economies of scale.
Exactly. By merging, Equitable and Corebridge don't just get bigger. They instantly eliminate redundant software licenses, they consolidate overlapping data centers, and frankly, they fire redundant middle management. The explicit goal of this merger is to save $500 million in run rate expenses.
Wow, $500 million.
Right. They are turning that saved cash into a substitute for cheap debt. Scale is basically the ultimate defensive shield against high interest rates.
So hardware companies are scrambling to adapt to AI efficiencies, and financial giants merge to survive the bond market. But what about the software titans? Because while the market is distracted by the Middle East and inflation, there is a separate existential threat creeping up on Silicon Valley. And it just dragged the NASDAQ down into correction territory.
Right, meaning the index dropped 10% from its record high.
Yeah. It is a legal curveball that could fundamentally alter the economic foundation of the internet as we know it.
It's a huge shift. For almost 30 years, tech platforms have been protected by Section 230 of the Communications Decency Act.
Right, the golden shield.
Exactly. It's the law that says a platform is not legally liable for the content its users post. If someone posts something defamatory or harmful on a site, the platform is viewed as the neutral messenger, not the publisher.
It's the ultimate don't shoot the messenger defense. And it allowed these companies to grow to trillion-dollar valuations because they didn't have to police billions of daily posts.
But that shield is now suffering catastrophic cracks. Meta and Alphabet, Google's parent company, they just lost back-to-back landmark cases.
Tell me about those.
Well, in New Mexico, a jury fined Meta $375 million over claims that their platforms facilitated child exploitation. And then, less than 24 hours later, in Los Angeles, a jury ordered both Meta and Google to pay $6 million. They ruled that the companies were liable for the severe mental health decline of a young woman who compulsively used their platforms.
And the critical breakthrough here, looking at the sources, is how the plaintiffs won. Because the juries in these cases, they did not base their rulings on the user content that was posted. They bypassed Section 230 entirely by focusing on product liability.
Yes, this is the turning point.
Section 230 protects what users say. But the plaintiffs argued that features like infinite scroll, auto-playing videos, and augmented reality beauty filters. They aren't speech. They are structural features deliberately built by the company's engineers.
Right. The plaintiffs successfully argued that these product design mechanics were fundamentally defective and dangerously addictive consumer products. If the feature itself is the danger, the Section 230 shield just evaporates.
So what does this all mean? I mean, if a digital structural feature like infinite scroll is legally treated the exact same way as a defective exploding airbag in a car, doesn't that threaten to completely destroy the advertising-driven business model of the entire internet?
It absolutely does. It forces tech giants to fundamentally rewrite their economic social contract. I mean, for years, the business model has been to design algorithms that maximize user attention at all costs, simply to serve more ads.
Right. Keep eyes on the screen.
But if you design an algorithm to be psychologically addictive, and that design is proven in court to cause psychological or physical harm, you are now financially liable for product defects. You can no longer hide behind the defense of, we just host the content. The architecture of the platform itself is now on trial.
And our sources show there are 2,400 similar cases currently waiting in the wings across the country. It's a literal deluge of litigation. No wonder Meta's stock dropped 7% on the news. It's not just a bad week in court. It's a structural vulnerability in how they generate their core revenue.
Investors are having to rapidly reprice the risk of owning these tech monopolies.
This has been an incredible web of connections to unpack today. Think about the journey we just took. We started with a dozen military mines placed in the waters of the Strait of Hormuz. We watched how that localized geographical chokehold cascaded outward, freezing global shipping and spiking Brent crude over $100.
It's all connected.
Yeah, that energy shock drives core PCE inflation up, which forces the Federal Reserve to hold Treasury yields near 5%. That in turn spikes the cost of gas to almost $6 in California, threatens the Kansas fertilizer supply chain, and forces a $22 billion insurance mega-merger just to survive the high borrowing costs. Meanwhile, the military burns through weapons, sparking a boom in rare earth mining for heat-resistant missile magnets. All while big tech faces an existential legal crisis over the very algorithms that made them billions.
It is a massive realignment.
It really is.
Yeah.
And for you, the listener, seeing how these seemingly diverse, chaotic events interlock, that is the ultimate superpower. Understanding geo-stagflation isn't just an exercise in macroeconomics. It's the exact lens you need to navigate your personal finances, your investments, and just understand the reality of the world we're living in right now.
It is entirely about seeing the whole board, not just the individual pieces. And before we go, this raises an important question for you to mull over.
Okay.
We just discussed how basic social media algorithms like autoplay or infinite scroll are now becoming legally vulnerable as defective, dangerous products. But what happens when we move beyond social media? We saw in our sources today that major hardware companies like Apple and Dell are heavily investing in the next wave of tech, autonomous AI agents.
Right, agents that actually do things.
Exactly. These are systems designed to take action on your behalf, booking flights, moving money, or even controlling physical hardware. If an algorithm is classified as a defective product simply because it keeps you scrolling too long on a screen, what happens when an autonomous AI agent makes a catastrophic error in the real physical world? Who holds the liability when the machine makes a choice entirely on its own?
Wow, that is the billion-dollar legal question for the next decade. If the invisible algorithms of our phones are causing this much legal chaos, autonomous AI taking action in the physical world is going to be an absolute labyrinth to untangle. The global system is in shock right now, from supply chains to the bond market to the legal code, and we are all just watching the arteries try to reroute. Thank you so much for joining us on this deep dive. Keep questioning the headlines, keep connecting the dots, and we'll be right here next time to help you navigate whatever comes next.